Welcome back to Behavioral Finance and FinTech. We've been talking about the expected utility theory and the Bayesian updating as a benchmark model of assessing those probabilities and reflecting those information. How does that get incorporated into our stock price and kind of things? Now, probability assessment. Well, how scientific are we, right? Good luck with that. Is there any biases? We're going to talk about it from now on in this video. Now, before I move on further, let me give you a interesting question, right? Some of you are from Germany and then some Europe, and then if there are some common history between you guys and us in long time ago, that's Mongolia. We all got screwed by Mongolia, invaded, right? Genghis Khan. Yeah, that's this group, a German group, singing Genghis Khan's, expansion into Europe and then East Asia, right? So my question is, right? When did Kublai Khan, the grandson or the last son of Genghis Khan, invaded Korea the first time, right? Salita is the name of the general, right? And then what is the year they invaded Korea for the first time? Of course, once they invaded, they lasted like 80 years or more, and then Yuan dynasty was, influencing all over Asia. But what was the year they invaded first, right? Give me a, 95% confidence span of yourself, right? About the first year they invaded. So I give you some time, 5 seconds, and then show me. What was the year that you assessed, right? As a confidence span, 95%. Some of you may have said that, it must have been I don't know, like 12, 10 to maybe 12, 20, sometime like this. Or even saying that, it must be 12, 25. 1 year, I'm sure. Just 1 year. Just 95 confidence span. You must be an expert? Okay. Some of you may have said, oh my God, it may be sometime like 1100 all the way up to maybe 1500. What the heck? I don't know. Some of you may say even like 0 to, I don't know, 2000. By that time, I would be like, let's be more serious, right? But let's forget about this part, right? This is not what we're talking about over there, okay? The correct answer for this one, in Korea, they invaded us at 1, 2, 3, 1 year. Easy number, 1, 2, 3, 1, right? Couldn't be an easier number, right? Anyway. So that's why I just asked you a little bit as a fun question. I mean, East and West, right? Europe and Korea, common history, right? We are the world in terms of, getting screwed by one empire in the history, right? Nobody expected that, right? We are the world, we are the children of, right? Genghis Khan maybe, right? Anyway, so that's this one. Now it tells, right? This confidence span tells a lot about your overconfidence, 근자감, right? If you are confident about this, then you will give a narrower, tighter range of 95% confidence interval or 99% confidence interval, whatever percent confidence interval. You will be very, very confident in a narrower range. That's what this overconfidence is about. Now, some people say it's overconfidence is about being more optimistic than pessimistic, but scientifically, it's defined this way: the precision or the confidence band that you give for any expectation, right? So those guys who are giving just 1 year, extremely overconfident. And then 10 years, very, very overconfident. And then wider band like this, you need some more confidence in you. Diffident, I would say. So, what's the implication over here? The narrower range you give, more overconfident you are, then more likely that you will be surprised to see the reality, right? For this guy, you must be surprised a lot. Oh, it's different from what I predicted. And this guy as well, right? But this guy over here, wider range, right? He'll be like, yeah, I told you so. Like, it could be somewhere over there. I'm not sure, not too much, but I'm not wrong either. Fine, right? That's how do you say? That's the benefit of being less confident, right? Overconfident guys get surprised much more often, more frequently. Now, why did I bring this example as a showcase of overconfidence, right? Well, we can switch our context into stock value estimation, okay? For example, Kakao Bank, what is your value estimate? 95% confidence band, right? So that beyond which you are going to either buy or sell, okay? If the price is above your value estimate, then you will say, oh, that's, overvalued, right? You're going to sell it. If the price is below your confidence band, you will be like, oh, that's undervalued, and let's buy it, okay? If it is within your range, then you will be, hold, don't do anything, right? So, for example, let's say some of you may end up saying, oh, the true value must be, 50,000 Korean won. Some of you may say, oh, maybe it's like a 48,000 to 49,000, like that. 1,000 one range, just one point estimate. And some of you may end up saying what? Oh, maybe that's 40,000 all the way up to 80,000. I just don't know. Right? Double right range like this, 98% confidence band. Now, having said that, once you observe the price and say, oh, today the price is at what? 61 per share. What would you do? For this kind of guys or that kind of guys, they would say what? Oh, that's, what is it? Overvalued. Above, much over, right? Much beyond my confidence band of 95%. Too expensive. This guy would say that's too expensive. Okay? If I hold that stock, this is good time to sell it. All right? This guy as well. The time to sell it. For this guy, they would say what? Hold. I told you it's gonna be somewhere in this range. No surprise. And then, all of a sudden, let's say the price moved to like this, somewhere in 47,000, right? What will happen? This guy will say what? Oh, that's undervalued. Let's buy it below my 95% confidence interval. And that guy as well. Oh, that's undervalued. Let's buy it. Right? Oh, didn't you say? Sell it. And now you say, buy it, sell it, buy it, sell it, buy it, sell it. You are going to trade frequently if you're overconfident. But this underconfident guy, what's going to be their response? They will say, it's not undervalued. It's just correct. It's somewhere in my correct value range. So hold, don't do anything. So less confident guys end up trading less frequently. What's the implication? Overconfident guys versus less confident guys. Which one will spend more money for as a transaction cost to the brokerage firms? Buy it, sell it frequently. Overconfident guys, they're going to ruin their portfolio holdings by frequently trading. Trading is hazardous to your financial health. Overconfident guys, ruin yourself, right? Underconfident guys, they're cautious, much more cautious over here, so that they don't move that much. They get very careful, so they don't lose money too much, right? So that's a nice contrast that I'm going to tell you. All right, so overconfidence. People set their subjective confidence intervals too tightly. They are surprised too often as a result. Some professionals are reasonably calibrating, but professionals, right? You have more expertise in certain field, like historians. You must have memorized the year of Mongolian invasion to South Korea, 1231. Yeah, you will be confident enough that, right? You will get it correctly. But usually, if it is not under your expertise, right, the confidence band usually tells a lot about your overconfidence degree, right? Bob Schiller, Nobel laureate in behavioral finance, he says that in interviews with investors, I find that overconfidence is apparent when they seem to express overly strong opinions and summary judgments, right? Overconfidence is mostly about standard deviation, the confidence interval that I told you before, right? I know it precisely. 내가 해봐서 아는데. It's like a kind of things, right? Sometimes overconfidence is about optimism, the positivity. Yeah. Like Olaf over there, if you watch the movie Frozen, right? Go ahead and watch it in your free time. Bob Schiller, yes, he looks like this. And then, how good a driver are you? Are you above or below average of the whole population in terms of your driving skills? If I ask this question, usually guys would say they are over average. They say, oh, I'm even compared to those male guys, I'm above average person in terms of driving skills. Are you sure? All right. Somebody, like a half of you have to be below average, but all of you claim that you're better than average. And if I ask the same question to the female population, and then they would say, I'm not that good, not that confident about their driving skills, right? But, even when they're compared to female population, are you better than average or not? And then most of them say like, I'm not that good. Okay, don't expect too much from me. Which one is more overconfident? Clear. Guys, right? That's what makes the world interesting, by the way. But there's a clear gender difference associated with it. I'm not saying that discrimination or anything, but we are finding some patterns, right? That is strongly related to these genders, right? It has to do with our evolutionary processes. By the way, we're going to get there later on. Overconfidence is an implication for finance, is that overconfidence can potentially explain why people trade so frequently, so much, right? I told you, those guys will be, buying and selling so frequently. Rational people trade far less often. No trade theorem is also there. If everybody is rational and then razor sharp in calculation, and then somebody comes to you and sell this kind of things, and then what would you say? Oh, why did you come to me with that? There must be something wrong with that one, okay? There should be some negative information. If it should be a stock, right? Of whatever company it may be, and somebody tries to sell it to you, and you will question, oh, adverse selection, 역선택 must be there. I'm not going to buy it. Go away. So people will not trade. But we are not filled with this kind of 100% rational people. Somebody are overconfident, right? They're willing to buy and sell, right? That's what makes the people interesting. The life is interesting. Half of them would realize their information is below average, but in terms of driving, so many people believe that they are above average, especially guys. Malmendier and Tate are great star professors that's pioneered this area of overconfidence, especially of the overconfidence of the CEOs. Malmendier, she's in Berkeley, UC Berkeley, as a big shot in economics department over there. And then Jeffrey Tate, he's in the University of North Carolina, Chapel Hill. And then also there's a big shot in overconfidence literature. You see Terry Odin. Odin is the same name as the Odin, the movie, right? Thor, and then those, Scandinavian, yes, that's the last name. He went to a university in Minnesota, by the way. Yeah, Minnesota, the Carleton College. But he has an interesting personal history. He initially wanted to become a clergyman, 성직자. And then he found that, it's not interesting. And he moved on to, Carleton College, one of the best liberal arts college in the whole world, in Minnesota, by the way. And then he got a job as a actuarial science guy in a company, the 계리사, 보험 계리사 job. And he went to Wall Street, I guess. And then the first week of the underwriter training, right? 보험 계리사 training, mathematicians, right? He liked the math, but the life of the insurance company turned out to be boring in the first week, and he dropped out. And he said, screw me, I'm not going to do that. And then what did he do? He started to drive taxis in New York City, right? And during his 20s, right, he spent his life, working in other fields like that, driving taxis and sometimes coding and then computer science a little bit. Very interesting career, by the way. And then he ended up with finance is very interesting. And then his age of 30 or beyond, he got into this finance PhD program, got his degree, and then became a professor at Berkeley. Yeah, and then became a star professor. What did he become a star with? Well, his research was about overconfidence. And then the thing is, he's a very sociable guy, I guess. I mean, at least he was very friendly to me as well in the conference. And then, taxi drivers, they are good at socializing, talking to anybody, right? Anybody can be friends immediately. So I guess he has this kind of personality, so that, he was able to talk to the CEO of Charles Schwab, a discount brokerage firm, right? And then the brokerage firm provided him very unique data, big data about individual investor trading. Of course, they eliminated those personal information like ID numbers or anything. They blinded it, but other informations like gender, age, and then race and all this kind of personal informations, not really personal, but that ethnic information, that kind of things, together with the trading record, right? How many shares were bought and sold, in what time, what minute, second, kind of things. And then the zip code, where they live, and this kind of things, right? So almost 70,000 people during the 1990s, right? With this, he tested the trading behavior of the individual investors, right? So what did he find? Well, before trading cost, average investors beat markets by 0.6% per year. Now that's good, but after fees, they trail or lose money compared to the market benchmark by about 1.8%. And then most active traders, which are supposedly more overconfident guys, right? They trail market by 5 percentage point due to those trading fees, trading cost, right? Transaction cost has a lot of implication about your overconfidence. If you're overconfident, beware. This is the point where the fintech service can get in there and then say, you're overconfident, guys. Stop trading, right? Of course, your brokerage firm will hate this because the brokerage firm's profit point is your overconfidence. But that's something the fintech companies can explore somehow. And then he had a series of paper about this overconfidence. And then next paper, he compared guys versus girls, right? Gender comparison within that data set. And he found that boys will be boys. That's the title of the paper. Boys will be boys. Bad boys, bad boys. That's a song of what, Miami Sound Machine. But I think the song has to change its title, like the verse, like what? Boys will be boys, overconfident boys, right? So guys are more trading frequently than girls and lose money. Yeah, right. If you believe that guys are better in trading performance, no, hell no, right? Why? Because of the overconfidence in you, right? And that kind of things was confirmed in Korean data as well. Last year, with the pandemic, COVID-19, so many people started to trade home. Guys and girls, which one performed better? Girls. Why? They are underconfident, which means more cautious. They don't move. They hold. Very cautious. They buy only when the stock price is deeply depressed. They sell only when it is extremely high. Otherwise, they just hold. Be cautious. Whereas the guys, I know stock market. I trade better than you. Which makes you to trade more frequently and miss the chance. And then lose money to your brokerage firm as a transaction cost, right? A lot of messages, right, to digest over there. Okay. So, whenever I make my investment decisions, I first ask my wife and my daughters, what do you think about this? Is it a good time to buy or sell? They usually say, hold on. Hold. Don't move. That's better than myself, right? Aren't you a finance professor, Andy? Yeah, I'm a behavioral finance guy, so that's why I'm resorting to my spouse, right? Anyway, overconfidence is, Kang Hwan-guk, a YouTube star in finance in Korea. He says overconfidence is your worst enemy. Two worst enemies in your investment. One of the worst enemies, overconfidence. The other is disposition effect or loss aversion. I'm going to talk about that later. Overconfidence, he says it's more like a Hitler of your investment life. Why is that so? Well, if you watch this movie, The Final Day or whatever of Hitler, he was, he was not an expert in military, right? But he was, overconfident in expanding back into Eastern Front, and then invaded Russia, while the German forces were fighting in the West Front, and then he was, confident to fight against the Soviet Union, and then betraying the contract they had made with Stalin. Say, 불가침조약, 독소 불가침조약, and then got screwed, right? Overconfidence. Don't go there, right? So that's the thing. Now, next video, I'm going to talk about the prospect theory, which is really exactly opposite telling a lot about against the expected utility theory. And then we're going to move on to disposition effect and then loss aversion associated with that prospect theory. Thanks for watching.